All right, guys, let's quickly take a look at the ISM services PMI coming up a little bit later. Now, I'm going to keep this short because we don't have a long time until we get to the event. We've got about a little bit over an hour. So by the time that this preview is released, you'll only have about 40 minutes or so to watch it. So I'm going to keep it as short as possible. You guys know why the labor market is important right now. We went through that in a lot of detail in the preview to the jobless claims and continued claims. So I'm not going to go through that again. Labor market, short and sweet, super important right now. We saw the reaction from the dollar as well as yields to a miss in the claims data, which was just marginal. I mean, expectations was 235. We came in at 238. For the continued claims, we did, however, push above the market's maximum expectation. And that was, to be fair, that was the highest print of this cycle so far. If we just quickly see if this data is updated, just to show you guys that data. There we go. So that is the highest print of the cycle so far, and you can see that was a marginal miss in the data. But look at how the dollar responded. Big downside in the dollar, big downside in yields. What was interesting though was that equities also pushed lower despite the move lower in both the dollar as well as yields, which in my opinion means we need to be very careful with trading equities on the back of the ISM print. I would prefer to just stick to those markets that have shown us their hands, that has shown us that reaction, and that is obviously looking at the US dollar. Now, in terms of this print, like I said with the initial claims, for the initial claims, my view was that I wouldn't want to be trading this as a beat. I only wanted to trade it as a miss, which of course is what we got, but it wasn't big enough to get me into a trade out of the claims data. When it comes to the ISM, based on how the markets reacted and after the comments that we had from Fetcher Powell yesterday and how the market responded to that, I'm going to side with caution here, on the side of caution in terms of a beat. I'm going to skip a beat with the ISM services PMI today. I don't think I'm going to trade it. I think the only thing from a sentiment point of view, from a price action point of view, from a positioning point of view, from a narrative point of view, to be fair, that makes sense right now is trading this as a big miss if we get one. I just think that's going to be the simpler trade to be had. Now, don't get me wrong. If these numbers comes in super hot and it shocks the markets, then by all means, we could see some upside in the dollar. We could see some upside in yields, and that could well be tradable. But when it comes to risking your own capital, as we all do, in terms of my own capital, I'm gonna keep mine for a miss. I'm not gonna trade this as a beat. Just disclaimer on that. So in terms of what I'm looking for here, obviously a miss across the board. We've said this many times trading the ISM prints. Don't just look at the headline. We always look at the totality of the data. That means you look at all of your sub indexes as well. Business activity, employment, especially employment now, new orders, prices paid. You look at all of these things in totality to give you a sense of whether this was a big miss or a big beat. There are some occasions when it's okay to trade a mix in the data. For example, if we get a Goldilocks print where you have inflation down but the growth measures up, or a stagflation print where you have your growth measures down but your inflation measures up. However, like I said, when it comes to this particular print, I think the only thing that makes the most sense to trade would be a big miss across the board. That means we want to see as many of these measures, preferably all of them, showing us red across the board. Now, what makes this slightly trickier to trade is that we don't have consensus for things like business activity, employment, new orders, prices paid. We only have it for the headline index. So for the headline index, we can drill down into a little bit of specifics, looking at more nuanced numbers that we would expect to see some reaction from. When it comes to the other measures, the other four where we don't have consensus, there we'll need to rely on seeing a number that comes in below the prior in the form of a miss, or above the prior in the form of a beat. However, and as always, that 50 level is the magic level, right? That is where you want to see preferably numbers pushing below or pushing back above. So for example, with employment, if employment should push from 47 to above 50, that'll be seen as a very big positive, right? If you see things like your new orders and prices paid push from above 50, especially the headline index, to below 50, that'll just add to the conviction. It'll add to the weakness of the print or the miss in the print, or if it's above 50, obviously to the beat in the print. Like I said earlier, I'm only going to trade it as a miss. So I'll be looking for those numbers to come in as close to, and if we are lucky enough, below 50 as we can. I mean, If we can get below 50 on some of these that are quite high, like new orders and prices paid, that'll be fantastic. But it's a big drop, to get from 61, for example, of business activity to below 50. New orders, we might be able to get there. But prices paid and business activity, that's going to be a stretch to push that below 50. As long as there's a big miss across the board, though, it should be enough, even though we might not see a number below 50 in all of these. Now, in terms of the headline index, we can see expectations is for this to drift lower from 53.8 down to 52.5. We've got a minimum expectation of 51.5 and a maximum of 55.5. Now, if we take a look at the forecast distribution under the hood, we can see that the minimum of 51.5 as well as the maximum at 55.5, these are clear outliers, right? However, when it comes to these prints, anything below 51.5 would be a massive surprise for anybody that was polled for this. It will also be a decent acceleration from the prior of 53.8. But if we can get below 50, that'll just be the perfect type of miss. I would take something that's below 51 at 51.5 or lower. I would take that as a miss, especially if all of the other measures comes in lower as well. But preferably, if we can crack below 50, that'll just make it so much better as a miss. In terms of a beat, for those of you who want to trade it as a beat, like I said, I won't be looking to trade this as a beat today, only as a miss. But for those of you interested to trade it as a beat, look, I think anything above 54 will already be a big surprise. It'll also be an acceleration from the prior number, which is 53.8. I do think, though, a PS above 55 would just be so much better as a beat, right? It'll surprise everybody except one particular analyst that was polled for this. It'll not just be above the prior, it'll also be a 1 standard deviation beat in this as well. So I would say above 55 is what I would want to see if I was going to trade this as a beat. Like I said, I won't be looking to do that today. So let's just say we do get a nice big miss across the board. How will I be looking to trade that? Well, like I said, I'm going to keep it simple and look for more dollar downside. What's tricky about the CAD, I like the dollar CAD as a potential sell, but we are now trading at that next key level of support that we were looking for, which makes it a little bit trickier. I never like buying things into key levels of support, but whether you are selling into key levels of support or buying, in the case of euro dollar, into key levels of resistance, it's pretty much the same thing. So the risk is there. We need to be wary of that, cognizant of that. But if it's a massive, massive miss, look, the euro is, apart from the pound, the strongest currency on the session today. I like euro here because I think the big reduction that we've had in the spread also lends some upside here to the euro. So I like this to the upside. The challenge is you'll be trading this into key levels of resistance. You've got 1077, which is a level of support and resistance. You've got the implied volatility high for the day. You've got the 200-day moving average. And I do think I saw earlier that we might actually be trading into the there we go. We're actually trading into the 50-day moving average as well. So you've got the 50, the 200, the implied vol, as well as the 1077. 107.77 at least. So this is a key level. If we break above it, though, we could be seeing a potential push towards the 108 psychological level. That comes in close towards the implied volatility high for the session as well. So just be cognizant that you'll be buying into key resistance in the case of euro dollar. You'll be selling into key support in the case of dollar CAD. But you know what? If the data comes in weak enough, I would expect that to continue, right? So there's always a risk, so be mindful of the risk, but euro dollar would still be an option here, in my opinion, as well as dollar CAD. Both of them could be options, but I'm probably going to stick to euro dollar. It gives you slightly better chances on the liquidity side as well. So that's the way I'm looking to trade. A big miss in that ISM, looking for euro dollar upside. Again, not in the markets right now to be trading this as a beat. Just feels a little bit too skew towards the recent price action, as well as the sentiment that we're seeing across the major asset classes after that jobless claims data.